Hi, this is John Holohan, and I'll be presenting the Proactive Investment Strategy Update for Friday, June 2nd. Well, in today's update, as usual, we'll go through our market model, and this week we'll also go through an updated economic model, and that's all in the backdrop of conflicting signals in our model. Market model has been positive since November of last year, yet the economic model was negative at that point, indicating the possibility of a recession in the coming months was likely, and therefore we've proceeded cautiously. During that time, we've seen a mostly sideways market with a slight upward bias. And when I say that, I mean a broad market in a broad market sense, because there have been some pockets of strength. In particular, recently, you've seen some of the mega cap stocks really put in a good showing, and we were concerned about a narrow rally. In other words, very few stocks participating in a market trend. That's generally not a good thing for the sustainability of the trend. We've been looking for some confirmation of a broadening out of the rally, and perhaps very recently, we're beginning to see some green shoots on that front. And I'll get into that in a little bit of detail in just a bit here. And perhaps a catalyst for that is the recent negotiation of the debt ceiling increase, and perhaps a bit of a what I might call a relief rally going on in the market these past couple of days, as kind of a big potential market scare maybe has been put to bed for now. And so we're beginning to see markets rally off of that news, as well as the other recent report, which was the employment report today. Markets seem to receive that reasonably well, that we had 339,000 jobs created, albeit with a slight uptick in the unemployment rate. So that could be a bit of a mixed message to the Fed in terms of shaping interest rate policy. So let's begin our report with a review of our market model. So here at the dashboard, we can still see that it's green across the board in terms of the signaling. The global buy signal triggered on November 30th of last year. The core indicators, which are the longer term indicators in our model, looks like a little bit of a mixed bag, but favoring the positive side. Cash comparison showing as negative, but there are just some minor technical reasons that it's still showing negative. Long-term momentum indicator remains positive, and we did have a month-end reading on that. So let's begin with that chart. So here's the long-term momentum chart. We've got a 10-year view here. Recently, we've been reporting about, coming off of this downtrend here into a low last October, and then the move up, which caused us to switch to positive reading, then flip back to a neutral reading, and now positive again. So now we've had 3 positive readings in a row. That's an encouraging sign. We also like to point out that this important momentum indicator had reached an extreme low, and oftentimes there could be good progress in the global index coming off of those types of levels, those extremes. And you can see in the past when we've transitioned from a bearish trend to a bullish trend, generally there might be some back and forth, some neutral, some positive, some neutral again, before a trend can get underway in a significant way. That happened back here coming off the COVID low, a lot of back and forth with this indicator. And then again back in 2015 into 2016, some back and forth, and then a solid period of positive readings in this indicator was accompanied by a nice strong uptrend in markets. So we'll have to see if this period here was a good enough shakeout of risk to really refresh the trend here. Again, all of this in the context of our concerns about the economic model and its recent weakness. And so we'll have to see if this momentum can kind of, if you will, overcome some of the storm clouds on the economic horizon. And a little bit later in the report, we will check in on the latest readings on our economic model. The other core indicator, the universe trend indicator, really no changes of any significance in these charts, so we'll skip on to our tactical indicators. And here we'll start with the 10-week indicator. So with the percent above 10-week indicator, what we're measuring here is the percentage of stocks that are currently priced above their 10-week average price. And we can see a general downtrend in the early part of the year and then an attempted rebound here. So this is, if you will, declining market breadth, fewer stocks participating in any uptrend. And conversely here in April, we saw the reversal up. And now more recently, during May, we've seen a stalling out in this indicator. So we've commented before about our concerns about market participation. In other words, is this market trend being driven by, just a very narrow number of stocks? And that is what we're seeing, particularly in an index like the S&P 500, where the mega caps have been really leading the charge and have just a very strong influence on the overall index. So when you have a market cap weighted index like the S&P 500, a few stocks can very strongly influence the movement in that index. So even though the index has been rising for the year, this recent weakness is very much a concern to us. Now I'll show a little bit later on, there is some interesting market action today where perhaps we're beginning to see some green shoots. We actually see some very good performance from other areas of the market today, particularly the small caps and the mid cap stocks have been exhibiting outperformance in a strong way today versus the large cap indices. So for us to have stronger confidence in the current trend, we really do need to see this indicator stabilize and begin to advance from here. That would tell us more and more stocks are beginning to participate in the trend. Here's our overbought oversold chart, and I've got a 3-year view right now up on the screen. And just to put things into a little broader perspective here, the peak in the market in late 2021 into early 2022, you can see after a very tough year in 2022 for this all country world index, a nice rebound, but recently more sideways action. And you can see we're very well off of the all-time highs in the index. It's probably, let's call it 14-15% off of the highs put in late 2021. We've also pointed out that really since the beginning of 2021, there's been virtually no progress in stocks globally. Now, if we drill in on this just a bit, so if we drill into a 1-year view, you can really see some of the sideways action that's occurred really throughout this year, again, in a broad global index. So in an index made up of nearly 4,000 stocks worldwide, there can be just a big variation in performance from region to region, market capitalization in stocks, large, small, and mid cap. But when we're moving sideways like this, it's almost a little bit of indecision in the market. And we've pointed out before, we believe this is an important level that if we get real conviction about this current trend, the market really has to penetrate this in a meaningful way and have the market broaden out in terms of additional stocks participating in the rally. But you can see, going back to similar levels, an attempt to break out almost a year ago and really a failure to do so, repeatedly bouncing back off of these levels. And now, perhaps this is just a consolidation as the market looks for clarity. Perhaps the deal with the debt ceiling limit and its increase, perhaps that's the catalyst that will enable this market to really establish the trend in a more significant way and again broaden out to include more stocks. Next, I wanted to review the difference in performance this year in a large cap index. We'll use the S&P 500, and versus a mid cap index, we'll use the S&P 400, and a small cap index, the S&P 600. So again, year-to-date performance, we can see large cap, the S&P 500 itself, is up significantly more than mid cap and small cap. And this is what we have been stressing in terms of the market breadth, the participation of stocks. There's a lot more stocks in the mid-cap and small-cap universe down here that have been relatively underperforming the, let's call it the smaller universe in the S&P 500. Again, the S&P 500 driven by a relatively small number of very large stocks due to the fact that that's a market-weighted index. Now, maybe what we see as a bit of a green shoot here is very recent performance. The last couple of days here, particularly today, we've begun to see an expansion of that upward market trend in the form of the small caps and the mid caps participating in a significant way. So think of it this way, largely flat performance from most stocks in the market, and then the large cap universe is where we see the strength, and in particular those very limited number of mega cap stocks. Now let's drill down and look at today's performance. So here's an intraday chart of the same indices, and we see a big difference. We see the relative underperformance coming from large cap, the S&P 500 itself. But then look at mid cap here in the orange line on an intraday basis, up 3.09% versus 1.47% for the S&P 500, and then small cap, even greater difference in performance with small cap up 3.53%. So more than double the S&P 500. So is this a green shoot here? Is this the beginning of the expansion of that? What we've been looking for is that hint of an expansion of breadth in the market. We don't want to get ahead of ourselves, but this is the type of early sign that could develop into something more meaningful and could lead to a more sustainable uptrend in the current market. So let's shift gears and look at our economic model. So here we are looking at an updated model through the end of April of this year. As I said earlier, we use our economic model in conjunction with our market model in making decisions. We've pointed out in previous reports when the index itself drops below zero, it's generally a pretty strong correlation with an upcoming recession. The periods in gray are recessionary periods, and as we go back in time, first of all, you see the COVID, very brief recession associated with COVID, and a very strong drop in the indicator. That was almost coincident with the recession, just based on the nature of that. But if you go back to the bursting of the real estate bubble, you see this indicator dropping below zero, and then not too long after that, you see the recessionary period. The same thing back here in 2000 at the so-called tech bubble, and we can go back in time and see kind of a pretty decent correlation with the indicator dropping below zero and then a recessionary period following not too far down the road. So this is one of the reasons that we've been so cautious, in that we would expect at some point that a recession would occur. It's difficult to say exactly when, or the severity for that matter. Now we do see a little bit of an uptick in the weekly indicators here, so it's a more sensitive version of the economic model. We're not going to read too much into that, but an improvement is encouraging to see from an economic perspective, certainly. And if we switch to the monthly version of this, we can see some, continued deterioration, although maybe a little bit of back and forth in both the long leading indicator and the monthly indicator. But again, the overall way to view this is it dropped below zero last year, and that could be associated with an upcoming recession. We can't predict that for sure, but it remains very much on our minds in terms of risk as we navigate really conflicting information, a positive market model and a negative economic model. So to wrap things up for this report, again, we've got somewhat conflicting information with a positive market model, albeit with relatively weak breadth, in other words, relatively weak participation of a large number of stocks, in conflict with a negative economic model, where we would anticipate a recession in the coming months. The very recent strength that we've seen in stock prices with the agreement on the debt ceiling increase, Perhaps that could be at least a short-term catalyst to foster some broader stock participation. Again, we're seeing perhaps some green shoots early on in the last day or two of more stocks participating from the small cap and mid cap areas of the market. If we continue to see that expanding market breadth, that could lead us to expectations of opportunities to grow portfolios. And so we'll monitor things very closely to measure the progress. We've said all along we simply can't predict how deep a recession might be or exactly when it might come, but we just feel the likelihood of recession is certainly elevated. But you never know. The market may already be discounting the effects of a recession. You simply don't know. We'll know only after the fact. So please stay tuned and join us for our next update in 2 weeks. Have a great weekend.